In this video, we will explore the trading mechanism of futures and options. We are going to look at the rules, the regulations, and the systems that make these markets work for every trader. To understand how we trade today, we first need to compare the two main ways markets have operated over the years. In the old system called open outcry, professionals would communicate by shouting and using hand signals in a large physical hall known as a pit. Today, we mostly use the electronic market where everything happens through digital data on computer screens. In India, our futures and options markets are fully automated and screen-based, which makes the whole process very transparent and efficient, much like the regular stock market. Now, let us meet the different players involved in the trading of futures and options. First, we have the trading member, who is a member of the stock exchange and trades for themselves or for their clients. Then there is the trading cum clearing member, who can both trade and settle those trades. We also have professional clearing members, which are typically banks that focus only on settling trades for others. Finally, there is the self-clearing member who handles their own trades and their own clients' trades but does not settle for other trading members. Beyond these members, we have the participants, which is the name for clients who trade through these members. It is also important to mention authorized persons. Back on June 21st, 2018, the regulator decided to change how middlemen work. As a result, sub-brokers ceased to exist on April 1st, 2019, and they migrated to become authorized persons or trading members. If you are planning to trade, you must know when the market is open. Standard trading happens on all working days between 9:15 a.m. and 3:30 p.m. However, the stock exchange has the flexibility to set trading hours anywhere between 9 a.m. and 11:55 p.m. provided they have the right risk management systems and infrastructure in place. Within a professional trading firm, there is a clear corporate hierarchy to keep things organized. At the highest level, we have the corporate manager who oversees everything and has the special power to define exposure limits for different branches. Below them is the branch manager who looks after the trades and dealers in their specific branch. At the entry level, we have the dealers who can only view and manage their own specific orders and trades. The relationship between you and your broker is very important and involves many responsibilities. Your broker must handle your paperwork like the Know Your Client form and maintain a unique client code for you. They are also responsible for financial tasks like collecting margins and keeping your money in a separate bank account to keep it safe. Additionally, they must provide you with timely reports such as contract notes and periodic statements of your accounts. When you are ready to place an order, you can set certain time conditions. For example, a day order is valid only for that single day and will be cancelled automatically if it is not executed by the end of the day. If you want something faster, you can use an immediate or cancel order. This order tries to find a match the moment it enters the system. If it cannot find a match immediately, the unmatched portion is cancelled right away. You can also control your trades using price conditions. A limit order lets you specify an exact price or a better one for your trade. A market order tells the system to just get the best price available in the market right now. We also use a stop loss mechanism to help you limit your losses. For example, if you buy a contract at 100 and want to protect yourself, you can set a trigger price at 95. If the market hits that trigger, your order automatically converts into a limit sell order at, say, 92. So, how does the system decide which orders to match? It follows a very fair priority logic. First, it looks for the best price, which means the highest price for a buyer and the lowest price for a seller. If two orders have the same price, the system gives priority to the one that arrived first. This ensures that the market stays orderly and that every participant is treated fairly based on when they placed their bid. To help keep the market stable and prevent major errors, the exchange uses something called a price band. While derivatives do not have fixed price bands like some stocks, they do have operating ranges. For index futures and individual stock futures, this range is usually 10% of the base price. For options, the range is calculated every day based on its delta value. If you try to place an order outside these ranges, it will trigger a price freeze warning at the exchange. It is important to know that the rules for these price bands became even tighter recently. According to a circular from May 24th, 2024, the criteria for increasing a price band was updated. In the past, you only needed 25 trades from 5 unique traders. Now, it requires 50 trades, 10 unique traders, and 3 different brokerage firms on each side. This ensures that the price bands only move when there is genuine and widespread interest in the market. The market also uses cooling off periods and sliding price bands to keep price movements smooth. If a stock hits its limit, there is a 15-minute break after the first 2 increases. If it continues to hit the limit, the break time increases to 30 minutes and eventually to 60 minutes. Also, if the upper price limit moves up, the lower limit slides up as well. For example, if a range of 90 to 110 moves up to a top of 115, the bottom will also move up to 95. When you actually sit down to trade, you will use a professional tool called the Trader Workstation. This screen shows you the title bar, market tickers, and a market watch window where you can see live prices. When placing orders, it is crucial to identify them correctly. If a member is trading for themselves, they use the label Pro. If they are trading for you, they use the label.cli and include your specific account number. Finally, let us look at the 4 main types of instruments you can trade in this market. You can trade futures contracts based on an index or on individual stocks. Similarly, you can trade options contracts based on an index or on individual stocks. These 4 tools give you many different ways to manage your risks and explore different investment strategies in the futures and options market.